morning, everyone, and welcome to the British Chamber of Commerce VAT and Customs update today. My name is Daniel Eischen. I'm chair of the British Chamber of Commerce, and I'm very happy to have all of you on the call today for this surely very interesting and this very interesting event full of insights, because we have really very experienced and interesting people around the table. So welcome today. The topic really seems to be very interesting because we have 70 people also who have registered for today. So that's very positive. Let me immediately thank all the people from the tax group within the BCC who organized this event together with our partners. You normally would see Jonathan Norman also on this call. He has to excuse himself, and I would like to take just a second to congratulate him because he's become a father. So he's at home with his new family. So hello, Jonathan, wherever you are. Hope you're having fun and enjoying life. So we'll try to do the best without you today on this call. Another big thank to our sponsors today and also partner on our experts panel, Deloitte. So Deloitte has been generously sponsoring today's event. So thanks a lot for your continued support for the events of the British Chamber of Commerce. But I would like immediately to hand over to James O'Neill, who's principal at Maples and Calder, and who's going to be moderating today's panel and who's going to be coordinating all of that. So I will see all of you again at the end of today's webinar. I hope you're going to enjoy it and talk to you very soon. James, over to you. Good morning.
Good morning. Thank you, Danielle, and welcome everyone to the BCC Tax Committee's webinar on VAT and Customs update. We have quite an expert panel that has worked very hard to prepare presentations really up to date on what's going on in the VAT and Customs world. So just to remind everyone, the BCC Tax Committee, we're composed of about a dozen tax practitioners from all different areas of tax, from VAT, of course, as you see here, to personal tax and corporate tax, covering commercial activities, the financial services sector, and all the tax areas that are of interest to BCC members from all walks of life. In addition, the BCC Tax Committee, under Jonathan Norman's leadership, is quite active in lobbying and discussing with the relevant Luxembourg authorities, such as the Ministry of Finance or the Tax Administration, on clarity and always improving Luxembourg's tax regimes to serve the BCC membership community and Luxembourg in general. So, and just a brief plug, so as Daniel said, I am with the Maples Group. We have over 100 professionals in Luxembourg, and we're in over 17 jurisdictions worldwide, from Delaware to Shanghai. And okay, end of plug. And so with that, let us move to introducing our first panelist, who is Karine Bellony. I've personally worked with Karine for several years. She's got superb professional expertise, and she is the managing partner of VAT Solutions. And she has over 20 years of experience. And VAT Solutions, by the way, has been around since 2012, and she's one of the founders, if not the only founder. She specializes in pan-European VAT with a strong emphasis on commercial. Although I can also say we've collaborated quite a bit on financial services in the fund sector as well. And VAT Solutions is growing. They're currently at 8 professionals, and they'll be moving up to 10 soon. So Karine will give a presentation on VAT updates and the new free trade agreements between the UK and the EU. And so with that, would you please welcome Karine? Thank you.
Okay, so good morning to you all. I'm going to share my screen to facilitate the explanation about VAT changes we have prepared. Okay, so I hope everybody has a good view on the presentation. So first, I'm going to comment some recent VAT changes in Luxembourg and indeed give a few explanations about the customs impact of the free trade agreement between the EU and the UK. Well, to start with, what changed with VAT starting 1st of January 2021? We had some slight updates. First change in the VAT law concerns small entrepreneurs who have a quite limited volume of activities. Until 2021, the qualification of small entrepreneur was granted for entrepreneurs whose yearly turnover was below 30,000 euros. This threshold has been increased to 35,000 euros starting 1st of January. Another change with the difficult period we are all living linked to COVID, the coronavirus, is the implementation into the VAT law of temporary VAT exemptions until 31st of December 2020 that will apply on anti-COVID vaccines, on in vitro test devices and all closely related services. This VAT exemption is foreseen by the Article 43(1)(t) of the VAT law, meaning that it opens a VAT deduction right for the companies who are involved in such activities. The changes have been also commented in a circular 806 at the beginning of the year. Another change, you may be aware that some renovation work can benefit of a super reduced VAT rate of 3% if some conditions are fulfilled. Until the beginning of the year, the super reduced rate was applying under the condition that the building was more than 20 years old. The condition of the age of the building is now reduced to 10 years old building in order to enhance as much as possible renovation of such building and to save energy. So these were some changes starting January 2021. Another change that we will come most probably in, that will come in the market in the coming weeks, months, is linked to a case rendered by the European Court of Justice on the 20th of January 2021. It is a case C-288/19 that has been commented by a circular of the VAT authorities recently. So why is that case quite important? It relates to the case where a Luxembourg employer is having a hiring agreement with an employee, and the employee has the exclusive use of a company car, which is a quite frequent setup in Luxembourg. Until now, the reasoning behind the private use of a company car, because it's all about the private use of the company car, was, well, I would say quite simple. It's not true, but it was a binary approach. We were having a look if the company who was providing the car to the employee had recovered VAT on the company car. If the answer was yes, the company did recover VAT on the company car, there were some implications. But if the answer was no, no VAT due at all on private use of the car, so no VAT recovery, no specific matter about VAT for the company car, for the company. But if the company recovered input VAT on the car, then we had a deemed service that had to be declared for VAT, pursuant to the Article 16A, and Luxembourg VAT was due. So the subject about the Luxembourg VAT due was around the determination of the taxable basis. The VAT law foreseen one way to compute the taxable basis. It's the Article 28(1)(c). The taxable basis should be computed based on the expenses. So it had to be determined for all expenses, how many kilometers I made for professional purpose, how many kilometers I made for private purpose, and to apply that percentage on the VAT recovered. So basically, it means the only way to have a real allocation is to keep a logbook in order to follow, to track very carefully the number of kilometers made for private purpose and the number of kilometers made for professional purpose. Some other ways exist to compute the benefit in kind and therefore the amount of VAT that has to be paid. One that is quite frequently used is to use the taxable basis for the benefit in kind declared on the salary. Another one is to use a flat rate percentage computed in a certain way to determine the amount of VAT I have to repay because of that deemed service. I put these two alternative ways in a light gray because if you have a look at the circular, the only way the authorities comment is the real allocation of the expenses. So there is a general trend that should push you to be careful when using one of these two alternative ways to report VAT, because it may be that VAT authorities might challenge in the future some of these alternative ways, asking to apply the real allocation of kilometers. So as you see, there is already some kind of strong subject about company car. But the ECG case is bringing a preliminary question that was not necessarily covered before. What is the question that you should cover? It is to determine if the employee is paying a personal contribution or is giving up a part of the remuneration, or if is giving up any other advantage against the use of the car. If the answer is no, then we stay in our classical reasoning. We need to check, did the company recover VAT, yes, no, and this remains unchanged. But if the answer is yes, there is a personal contribution, then we should have a look if the use of the car qualifies as a long-term hiring. So the ECG case has defined what is a long-term hiring. It is a right to use the car and to exclude other persons from doing so for a period exceeding 30 days. And the car remains permanently available to the employee, including for his private use. So if this definition does not fit to the situation of your company, then there is a need to review the parameters to confirm what will be the VAT treatment, because there is no clear answer. If this is not a long-term hiring, it could be a short-term hiring, it could be non-exclusive use, and every parameter would lead to a different VAT conclusion. If the answer is yes, which I guess is actually lots of cases, then the particular rule for long-term hiring of means of transport applies because it is a service against remuneration. And VAT is due in the country of the residence of the employee. So with the consequence that the company granting the car to the employee should register for VAT abroad in order to report VAT due on the long-term hiring of car to the private person. Starting 1st of July 2021, the company can use the one-stop shop that Michel is going to explain further later on to declare that VAT. But until 1st of July, there is no choice. It is a VAT registration abroad that has to be done. So several questions arise together with this new approach. The first point is that every company giving company car to the employee should carefully review the car policy and the employment agreements to determine in which case they are located. There is a question about retroactive effects because the circular does not comment anything about when this approach will be investigated by the VAT authorities. And it is not only a Luxembourg question, it is also abroad because it will be the interest of the other member states to collect VAT on these company cars. Another practical question is what type of documentation should be kept on board of the vehicle? Because if we have a look at the practice in Belgium, they are quite demanding to make sure that VAT has been correctly paid on company cars. So most probably it should be prepared to keep some documentation on board in case of control. And also what will be the impact on VAT deduction rate? Because if we consider that the car has been hired to the employee against consideration, this opens a VAT deduction on the leasing paid by the company. So as you see, it brings a new approach, it brings a certain number of questions, so you should be very careful and review the car policy of the company. Now, a few words about the main customs features of the EU and UK trade agreement. So you all lived the very intense suspense at the end of the year where we were wondering what is it going to happen with the UK. We are negotiating, the negotiations are not finished, but ultimately on the 24th of December, EU and UK reached an agreement that provisionally entered into force on 1st January 2021. What does that free trade agreement mean? By the way, it's a huge document, more than 1,400 pages, so you can imagine that many subjects are covered. Something very important is that the trade agreement does not release exporter or importer from the obligation to file customs declaration for trade of goods between EU and UK. But the trade agreement, and this is what it brings, it eliminates customs duties on most of the produce trade between the EU and the UK if the goods originate from the EU or from the UK. In order to originate, the goods must be fully or sufficiently produced in the UK or in the EU. This is where we can say they are of a EU or UK origin. One example, goods of Chinese origin that were stored in the UK before being dispatched to the EU do not originate from the UK because they were not produced in the UK. The elimination of customs duties is not automatic. To benefit of the relief, the origin has to be proved when the customs declaration is filed. So the agreement foreseen for EU to UK, if the invoice is below 6,000 euros, it can be a mere statement of origin on the invoice issued by the seller. And if the invoice is more than 6,000 euros, the seller has to register as a registered exporter towards the customs authorities in Luxembourg. So you will have access to the presentation. You can click on the link and you will find some explanation from Luxembourg Customs about that specific status. For importation from UK to EU, it is a statement on invoice together with the UK AORE number of the UK seller. There is a simpler way to report. It's based on importer's knowledge. It is a very specific procedure that applies under specific conditions. The mostly frequently used way to prove origin is what I mentioned before, the REX or the mention on invoice. Last but not least, if you have a doubt, I think it's useful to mention that not all goods are automatically subject to customs duties. Some goods are zero rated by nature. So if you have some zero rated goods, you don't need to apply for the preferential origin. You don't need to have the REX number and so on. So if you have any doubt, you can check. I put here some link on the website of the EU authority of the Commission, the TARIC, to check if custom duties apply upon importation of UK goods into the EU. And if you export to the UK and you would like to assess application of customs duties in the UK, you can check on HMRC website. Well, this is what I wanted to comment about the free trade agreement. And I pass the word to the next panelist.
Thank you, Karine, for that very interesting presentation. Just to remind everyone, if you look on your screen at the bottom, in between participants and chat, you will see Q&A. So if you do have any questions, which we would love to get questions from the audience, technical or otherwise, please use the Q&A session function and we'll get back to you. Our next speaker is Guido Deloitte, who is, I'm sorry, I hope I'm saying that right. He is a partner at Linklaters with over 40 years of experience. And Guido is even a professor of VAT, and he's been teaching the subject for over 20 years. In addition to his expertise in VAT, Guido is quite active in VAT policy around the world. He has acted as a consultant for both the World Bank and the IMF. Some of the countries he's consulted on include Saudi Arabia, Latvia, and Suriname. And just before the COVID epidemic, he was consulting in Barbados, and he wants to be clear, it wasn't just a vacation. So with that, I'll hand it over to Guido. Look forward to a good presentation. Thank you.
Thank you, James. Good morning, everyone. I have a lot of slides, and you might not be able to have a good look at them during this presentation, but no panic, because they will be uploaded on the website of the BCC. So taking back control was, I think, the purpose of Brexit, and that was certainly achieved for VAT. VAT being an important tax in the UK, representing some 25% of all tax receipts. For VAT, the Brexit is what I would call a hard Brexit, meaning that the UK has become now a third country as of this year vis-à-vis the EU, and that it can now itself determine going forward its VAT system. So the UK will no longer be bound by the EU VAT rules, the directives, the regulations of the EU, as well as the case law of the Court of Justice. It will be able to determine its own VAT rates, its own VAT exemptions, its own VAT options. A particular attention for Northern Ireland, that and that is certainly linked to the Good Friday agreements, is still considered as a member state for VAT purposes with respect to goods, not with respect to services. So the UK will no longer have to wait now to implement any changes until all the member states agree. As you know, there is a unanimity requirement at the EU level in all tax matters. Although the UK will be free to determine its VAT system, it is expected that it will remain aligned with the EU VAT rules, specifically, I would say, with respect to some basic rules like place of services or place of goods rules. Otherwise, obviously, we would risk to have a double VAT or no VAT. Another bonus on the exit of the UK from the EU is it will no longer have to contribute to the EU institutions. Indeed, all member states have to pay over part of the VAT receipts, and for the UK, that was an amount that I found dating back to 2015, so it should be presumably updated, but it was 4.3 billion euros. That is no longer due by the UK, obviously, as of 2021 to the EU. we will see that being outside the EU represents some advantages, but it's a mixed picture. There will be also disadvantages, both for EU taxpayers and private persons, as well as for UK taxpayers and individuals. To be noted here also is that the UK will join actually Guernsey, Jersey, and Gibraltar, territories, UK territories that have never been part of the EU. The difference between these islands and peninsula and the UK is that whereas Guernsey, Jersey, and Gibraltar are VAT paradises, they don't have VAT, surely that will not be the case of the UK. So there are two parts in my presentation. The first concern goods and movement of goods, and the second services. And we have to make a distinction here between B2B transactions, so between two taxpayers, and B2C. Starting with B2B in a moment, but what does Brexit mean first? It means, as I said, that the UK becomes a third-party country to the EU, and actually very like any other third country, like US, China. I have put here Myanmar, which is now, of course, in the headlights of the news, but you could name any country, Switzerland, even I would say the Democratic Republic of Congo. The UK is in mostly the same situation as these third countries. So goods, movement of goods between the UK and the EU will be considered to be imports and exports. And import VAT will, or is now due as of the 1st of this year. The taxable basis being the price plus customs duties, if any. Again, we have an agreement that in principle is avoiding any customs duties, but as Karine just told you, that is always on the condition that the goods have UK or EU origin, and if that's not the case, then custom duties are due, and these custom duties will be part of the VAT taxable basis. So we'll have VAT on a base including custom duties, a tax on a tax. So this is the case of a UK business selling goods to a Luxembourg business while the goods are being transported to Luxembourg. Before Brexit, this was considered to be an intra-community transaction, an exempt intra-community supply of goods in the UK, and a taxable intra-community acquisition of the goods in Luxembourg, whereby the Luxembourg purchaser had to revert charge the VAT. Post-Brexit, so as of this year, this transaction now is an exempt export in the UK and a taxable import in Luxembourg. And the customs formalities and controls are now replacing what used to be the European sales listing and Intrastat statistical data to be provided. This is slowing down the transactions. It's one of the disadvantages of the Brexit as far as VAT and also customs is concerned, of course. And all of this has led, according to an article in The Guardian, to UK companies, smaller companies establishing an affiliate company, a subsidiary, for instance, in the Netherlands, in order to have bulk shipments instead of shipments product by product or order by order, so as to avoid having to go through all the formalities for small shipments and then store the products in the Netherlands and distribute them from the Netherlands throughout the EU. So post-Brexit means also, as I said, that in this case, where goods are being shipped from the UK to, for instance, Luxembourg, VAT will be due on import if the import would be done by the UK seller, then he will have to register for VAT in Luxembourg, and the UK no longer being part of the EU, he will have to provide for a bank guarantee, which was not the case before. That bank guarantee will only have to be provided assuming that the UK seller did not already have a Luxembourg VAT number. But so if he didn't have a VAT number yet, then he will have to provide for a bank guarantee. As far as the justification for the exemption is concerned, obviously the rules with respect to intra-community acquisition and supply do no longer apply. These will now be the rules provided for export. So what do you need in order to justify the export? It's the contract, a copy of the sales invoice, transport document, payment document, and of course, the customs declaration. The same rules actually, or the same analysis can be made with respect to a transfer of goods that are not the object of a sale. Assuming goods, computers being shipped from the head office of a company to its Luxembourg branch, before Brexit, they were deemed to be an intra-community supply and acquisition. As of this year, the export-import rules will apply also in this case. B2C transactions. Here we have the situation before Brexit, so up to the end of last year. A person would buy goods in the UK and then have them transported to Luxembourg. The distinction to be made was, well, if he is going himself to, let's say, for instance, London to do some shopping and to buy the products there and then have them transported back to Luxembourg, in which case UK VAT was due, no Luxembourg VAT, or whether the vendor would take care of transport, in which case, under certain condition, the so-called distance sales regime applied would be due, and that the UK vendor would need to register as a VAT taxpayer in Luxembourg. As of the 1st of January this year, so post-Brexit, well, there are two situations. The first one is the goods are being shipped to the Luxembourg client that he has ordered in the UK. He does not, the client, take care of transport. Well, in that case, this would be an exempt export in the UK, and the import, there are some exceptions, as we will see, is as a rule taxable in Luxembourg. If you would do some shopping in the UK now, to the extent, of course, COVID allows, and buy some goods there, what would be the situation then, and bring them back to Luxembourg? Well, there is some bad news here, because the tax-free shopping is, UK recently decided to abolish it, so you will have to pay UK VAT on that. You will not be able to get any refund of that VAT. And you might also need to pay VAT on importation, but you have these thresholds, meaning that if the value of the items you purchased in the UK is lower than, for air travelers, 430 euros, then there is no import VAT. But you might end up in paying actually VAT twice in the UK, and upon importation, if the value is more than 430 euros for air travelers. The UK travelers, they have an advantage over the EU travelers because the EU has maintained its VAT refund for travelers for non-EU tourists, and the UK now being non-EU. So the UK travelers can happily purchase in Luxembourg items, and if the value is at least 74 euros, tax included, then they can ask for a reimbursement, and obviously they might have to declare that upon importation. That depends on the UK rules. I will skip the following slides. They are giving you a list of exemptions on importation. The first on small value consignments of 22 euros is a very temporary thing because that will be abolished in July next year. I think Michel will perhaps say a word on that. And you also have another exemption for non-commercial dispatch when you move the place of residence in the framework of a wedding, in case of inheritance, for studies, etc. A small word on the UK small businesses. There are some 3 million of them. Before Brexit, they were able to exempt from paying VAT if their turnover is less than £85,000, which is to be compared with the 35,000 euros new threshold that Karine just told you about. Well, they now may have to start paying import VAT on sales to EU customers. Now let's move to services. What will be the impact of Brexit on the VAT treatment of services? Well, it could be in some cases neutral. In other cases, there is a positive effect, and sometimes there will be a negative effect depending on the case. Let's go quickly over these cases. The first one is, I would say, neutral. As a rule for B2B services, there is not going to be really a big change. There is a technical difference that there will be no need anymore to mention the UK VAT number on the invoice of the client, the UK client. However, some negative impacts, and the first one is both for goods and services, is here focusing on businesses that have to pay UK VAT, or UK businesses that have to pay have paid VAT in the EU and that would like to get a refund. Well, for the UK businesses, they will no longer be able to apply for the regime provided for EU companies, which is provided by this directive of 2008, providing for a paperless electronic procedure, which is much less cumbersome and more lenient than the rules provided for non-EU businesses provided by the 13th VAT directive, which now will have to be followed by the UK businesses claiming back EU in the VAT in the EU. I mentioned already that there may be a need to provide a bank guarantee for UK businesses when they become liable to Luxembourg VAT and need to have a VAT number. And another impact is on e-commerce. Again, this is a subject that will be discussed in a few seconds, but rules will change as of July the 1st. So this is just a temporary thing, but the UK commerce suppliers will need to register in an EU member state if they are going to supply EU commerce services to private clients, whereas before Brexit they could just use their VAT number in the UK And then to end with a positive note, there is a positive impact in a number of cases after Brexit for some B2C services, an example being legal services, consulting, accounting services, etc., provided, for instance, by a Luxembourg accountant to a UK private client before Brexit. Luxembourg VAT applied. Now there is no Luxembourg VAT. Obviously, there may be UK VAT depending on the UK VAT rules. Another positive impact is on financial and insurance services, which is important, I think, for Luxembourg. They will be zero rated, meaning that these financial services rendered to UK businesses or individuals, like a bank loan, will be zero rated, meaning that VAT, any input VAT will be deductible. Think, for instance, of the case of a lawyer that has drafted the loan contract and charges a fee with VAT. That VAT will be deductible if the loan is to a UK business or individual. Then there is the Scandia judgment, but I think I'm running out of time, so I will leave that to your reading. You just should know that Scandia concerns, this is judgment of the Court of Justice, a case whereby services are rendered by a head office or a branch to the head office, the branch or the head office. So it's a service in the framework of the same legal entity, whereby the head office or the branch belongs to VAT group. As a rule, there is no VAT due on services rendered within the same legal entity, but Scandia said that that is not the case if one of the two is belonging to a VAT group, and that leads to a situation whereby VAT is due on the service rendered to the branch in my example before Brexit. After Brexit, that will no longer be the case. And then we have also the use and enjoyment rule that will provide for a difference after Brexit. As you can see on this slide, no longer VAT will be due in this example. Same thing for transport services that may be exempt in case of international transport. And so I conclude then stating that there are some negative and positive impacts of this Brexit on VAT. Negative is, I think there will be more red tape. As for customs, the same thing, more strict conditions with respect to VAT reimbursement. We have the e-commerce and the provision of a bank guarantee, and positive is taking back control of VAT, no contributions anymore by the UK to the EU. We have some advantage in B2C services, the input VAT recovery on financial services, VAT-free tourism, but only for UK tourists, unfortunately not EU tourists, and this kind of judgment that is no longer applicable. Thank you for your attention, and I'm happy to reply to any questions you may have in the Q&A session.
Excellent. Thank you, Guido. And yeah, by the way, we do have the Q&A function. We'd love to get questions from the audience. So we're running a little late, so let us move to our third speaker, who is Michel Lambion, who is a managing director in Deloitte in its indirect tax department. Michel has over 20 years experience of VAT advisory and compliance services. He's worked at Big Fours and large law firms over the course of his career. He's a regular speaker and author of several VAT articles. In addition to being a member of the BCC Tax Committee, he has several other functions outside of Deloitte, including he is the chair of the working group of ALFI on VAT. Without further ado, I'll hand it over to Michel. Thank you, Michel.
Okay. Okay, do you see my slide?
Yes, we can see your slide, Michel.
Okay, perfect. Thank you. So I could start. Good morning to all. Happy effectively to be in this webinar. However, I would even be more happy when there will be the next physical meeting, and where the Deloitte would sponsor not only the event but also the drinks and the petit four. But I believe we still have to wait a few months before it could happen. So I will effectively quickly go around some 2021 changes that has been imposed by the EU. So that are European changes that of course applies to all EU member states, not only Luxembourg. The aim of these changes are on the one hand to fight against VAT fraud, and on the other hand to ensure or to improve the rules in order that the VAT is due where the goods or services are consumed. And this is quite consistent with the tax on consumption, that the tax is due where it is consumed and not where the goods or services are produced. I will refer often to the OSS. It's the one-stop shop. The OSS is one of the greatest inventions of the human being, even more important than penicillin or vaccine. It's a tool that allows a taxable person established in one country, in one member state, to collect the VAT in different member states. For example, a Luxembourg company would be able to collect VAT due in all the EU member states in one single electronic return. So from my working share, I could collect and remit the VAT of different member states. And it could look like that. I had turnover in Belgium, in France, in Germany, in Hungary, in Netherlands, and I had collected some money at the applicable VAT rate. So that's really the tool that will be mentioned several times during the presentation. So that's really some very efficient tool. As I mentioned, there is the aim of the changes are to fight against VAT fraud, because there are around 50 billion of VAT fraud in the EU. It's around 10% of the total VAT in the EU. This is thus an important fight, and a part of this fraud is due or by the use of the e-commerce, or at least the e-commerce has made the fraud easier and more important. For that, it's foreseen that the e-platforms or any taxable person that facilitate a transaction would be liable to pay the VAT on some transaction they facilitate. It's not all platforms. It's really platforms that intervene in the transactions. It's if it's only to provide for an information, or if it's only to relay an information to another platform, or if it's only to intervene in the payment, there is no responsibility of this platform for the VAT. But this is typically platforms like marketplace that will be in the scope. Once again, why? Because there is at least 5 billion of fraud. The platforms will be responsible in two situations. The first one is when there is an importation of a good from a territory outside the EU. It could be UK, but of course we think first to China. Well, effectively, you could find a lot of goods for good price, and often the Chinese seller would forget to respect its VAT obligation in the EU. And to avoid this loss of VAT, the platform that would facilitate the sale between the Chinese seller and the EU client will be liable to pay the VAT. The second situation where the platform would have a responsibility, it's when a non-EU seller intervenes in a sale of a good that is in the EU. For example, I am a UK seller, but I have a warehouse in the EU. I sell goods in the EU. In order to be sure that I do not forget to pay the VAT, the platform that will facilitate the transaction will be liable to pay the VAT. Of course, the platform is liable to all the VAT authorities, but you could easily imagine that the platform will implement agreements with the sellers to ensure that the VAT will be reimbursed or to the platform by the seller, because it's of course not the platform that will with its own money pay the VAT on the sale. I forgot to mention that these changes would enter in force as from 1st July of this year. If we take a practical example, I am a Luxembourg citizen. I order a good directly from a shop in China because I have found this shop during my last holidays in China, and will be more often the case, I ask a platform, I order the goods via a platform. Currently, the VAT is due either at the time the good enter in the EU, and for example, it could be in Rotterdam, and then the Dutch VAT is due, or it is possible to put the goods in a customs regime, and in this case, the VAT is due at the end of the regime. As I am a Luxembourg resident, I could the regime will end in Luxembourg, where the good is put at my disposal. But once again, there are a lot of importation that are not currently subject to VAT, because the importer, that would be probably the Chinese business, would forget this obligation. Moreover, there is this 20 euro exemption for small value goods under 22 euros. There is no VAT due, and there has been a lot, or there is a lot of fraud, because either the seller would split the goods in different parcels, of course, or maybe they will just pretend, oh, my good is of a value of 20 euros, and with the millions of parcels that go every day via the post and the transport companies, this is impossible to control everything. And there is an estimate that this fraud costs 7 billion euro of VAT, or 14% of the total VAT fraud. As from 1st July 2021, the regime will be different. There will be no more VAT due at the border, but it will be always the VAT due in the member states where the goods are put at disposal of the client. And if the good is put at my disposal in Luxembourg, it will be the Luxembourg VAT. If I have a secondary house in France and I ask the good to be delivered to this home, to this secondary house, in this case, it will be the French VAT. It's not the residence of the client that is important, it's where the good is delivered to this person. And to pay this VAT, it will be possible to use the EOSS, which is the Import One-Stop Shop. And it will be the responsibility of the e-platform or of the transporter or of the post to pay this VAT via the Import One-Stop Shop. So as from 1st July, there will be less cases, or there should be no more cases where you escape to VAT. This is a good news for the tax receipt of the states. Good news for the EU business that will not be anymore faced to unfair competition, but that's less good news for consumer that would not be anymore in a situation where they could receive less expensive goods because these goods escape to VAT. Then we switch to EU, and when again it's cross-border transactions, and once again the one-stop shop will be part of the game. We will first discuss about the distant sales of goods. These distant sales of goods are goods that are sold by business established in one member state, and the goods are transported by this vendor or on behalf of this vendor to another member state, and the client is an individual or some other categories such as NGOs or public bodies. In this case, there are specific rules. These rules apply only if the vendor is implied in the transport. Of course, if a French, for example, if a French resident would like to buy goods in Luxembourg, he puts the goods in his car, the Luxembourg VAT is due. If his car is not big enough and he asks the vendor to send to him the goods, in this case, this rules about distance sales will be applicable. This is clearly to avoid that member states with lower VAT rules, lower VAT rates would attract many of these distance sellers and would decrease the activity and the VAT receipts of member states with higher VAT rates. Currently, as I said, the aim is to ensure that the VAT will be due in the member states where the goods are put at disposal of the client. However, to avoid that small businesses selling low amounts of distance sales should register for VAT in the member states, there is a threshold under which they could continue to apply the VAT of their country. If I am a Luxembourg seller, I could sell in France with Luxembourg VAT if I do not exceed the French threshold of 35,000 euro per year. If I sold in Germany, it's 100,000 euro. And there is a threshold for each member state. This threshold is usually around 35K. Of course, this is a bit complex. And what is more important is that under the current rules, if I exceed the threshold, I have to register. And an estimate of the EU Commission indicates that the cost of registration could be around 8,000 euro of 8,000 euro per year and VAT registration. So if I exceed my threshold of 35 and then sold 37 in France, this will cost me this 2,000 euro additional sales would cost me 8,000 euro of compliance cost. The new regime applicable as from 1st July is the following. All these thresholds disappear, and in principle, any distance sales I made will be subject to VAT in the member states where the goods are put at disposal of the client. Does it mean that I have to register to VAT in all the other member states? No, because I could use the one-stop shop. I must also say that there is a threshold, a unique threshold of 10,000 euros. It's really for small, or let's say micro business. It's a favor for micro business. They will still be able to sell goods that are transported outside Luxembourg if the value is less than 10,000. But this replaces all the previous thresholds, and under the previous threshold, it was possible for a Luxembourg business to sold 100K in Germany, 35K in France, 35K in Belgium, so 170K. And if you consider all the member states, the total amount or the combined amount of the threshold were around 1.3 million for euro. And now all these thresholds are replaced by this unique threshold of 10,000 euro. The last change to be mentioned is not a change about the place of supply of services, but that this the OSS would be possible. It would be possible to use the OSS. It's all services rendered to consumers, to private consumers, that are taxable in a place other than the place of the supplier. I take an example. I am the happy owner of houses in Luxembourg, and I asked to a French painter and a German plumber to make some work in my house. They have the obligation to ask for a VAT registration in Luxembourg, and because the Luxembourg VAT is due. And this is true whatever is the amount of the services. It's asked from the first euro. Next, as from 1st July, they will still be obliged to apply the Luxembourg VAT, but they could use the OSS. They will not have any more to register for VAT. This is not applicable to all B2C services, cross-border B2C services, but because there are some services that are still deemed to take place where the supplier is established. It's typically the case of lawyer or accounting or advisory services. So if I am a Luxembourg lawyer, I will continue to charge Luxembourg VAT to my French clients, to my German clients, and I will report this VAT in my Luxembourg VAT return. And as mentioned by Guido, if I have a UK client, he will not suffer from the Luxembourg VAT. Here's some indication about the one-stop shop, the union scheme. I would not focus on all the details. The only point I have to mention is that it is optional. You would say, but why optional? Because this looks so great. It allows to save the compliance cost. So what will be the bloody stupid person who will ask a VAT number? It's because the OSS is only to collect VAT. But if I have VAT, let's imagine that I made some sales in Germany, but I also incur some VAT on my costs in Germany. In this case, if I use the OSS, I will pay the German VAT to the state. But for the refund of the German VAT on my costs, I will have to introduce a specific VAT claim. And this could be lengthy. So sometimes some people prefer not to use the OSS, but register for VAT. A very last word and quick word to say that the OSS for non-EU business has been extended to new category of services. In the past, it was only for electronic television and broadcasting services. Now it's for a larger range of services. So I thank you. I stop here. Thank everyone. I'm available for the questions.
Okay, excellent. Thank you, Michel. And thank you again also to Guido and Karine for your great presentations. We've gone over time. We do have one question from a participant who is a small business owner who would like help on recommending appropriate VAT advisor. Well, you have already 3 here to choose from. I'll defer to your judgment, and I think that's going to leave that question where it is. Do we have any? Oh, we have another question, I think. We have a question concerning, is it 35,000 euros, I believe, for all sales or for one transaction? I don't know, perhaps Karine, you might, or Michel, you might answer that, because I have a question for Guido.
Yes, so the 35,000 euros threshold is a cumulated value of all sales during 1 year. So assuming that in January you sold for 35,001 euro, the sale that makes you exceed the threshold will be subject to VAT in the destination country, but you don't need to revert to the previous sales. They remain subject to Luxembourg VAT if you ship from Luxembourg. So it's not one transaction. This is a global threshold for your sales to one given EU member states.
Thank you, Karine.
And maybe if I could give a detail, there is the threshold, but what is sometimes forgotten is that the person who benefit from this regime must still register for VAT and must provide every year with an estimation either with the amount of the turnover realized the previous year, because the VAT authorities want to ensure that the threshold is still respected. And it might be also worth to mention that it's possible to revoke this regime. And why to revoke this regime? It's because under this regime you could not recover the VAT on your cost, and sometimes it might be interesting to be able to deduct the VAT on your cost, even if you have to charge then the VAT to your clients, and if it's a bit more of a red tape, of course.
Very good. Guido, I have a question for you. In a transaction, your typical transaction between the UK and the EU, which rules apply? And the second part to that question is, I see you're quite involved in VAT policy with different countries around the world, and perhaps there seems to me a standard VAT regime that harmonizes VAT. But all that being said, do you see any instances because of Brexit where you could have double VAT taxation? And if so, when?
Thank you, James. So on the first question, I think you have to make a distinction between transactions between the UK and the EU after the transitional period, so as of this year. So there, the EU will apply its VAT rules and the UK will apply its VAT rules. But of course, you might still have issues popping up now with respect to transactions that occurred before the end of the transitional period. So let's say in 2020. And there, the withdrawal agreement provides that it is the EU rule, so the EU VAT directive, that will continue to apply with respect to any dispute regarding these transactions. So up to the end of last year, with respect to these transactions. So it's, but that is for a period of 5 years. So actually, the withdrawal agreement provides that predominance of the application of the EU VAT directive will apply up to the end of 2025, actually. So I think that's more or less a reply to your first question. The second question is about avoiding double or no taxation. Actually, it's obviously the risk increases when you have transactions between countries that have different VAT systems. But that being said, even within the EU, we have seen cases of double or no taxation that ended up in the Court of Justice, just because although the rules should be aligned, harmonized under the directives, the interpretation of member states sometimes was different. I think the most sensitive area obviously concerns rules about the place where services or goods are being deemed rendered. If there, as I mentioned in my slides, would be a different rule, then obviously you could end up in having double taxation, so I think should be taken into account by the UK and the EU. I think they will do hopefully what is required in order to align their rules so that these cases of double taxation or no taxation will not apply. Now, that being said, we already have one case, which I mentioned in my slides, that may lead to a double taxation. That is the Luxembourg person that would do some shopping in the UK would have to pay and then would bring the goods, the clothes or whatever he bought in a shop back to Luxembourg. He will, let's say, he purchases for 700 euros. He will have to pay UK VAT because the UK has decided to abolish the tax-free shopping. And upon importation, again, VAT would be due. So it's, I think my international experience has not learned me the Deus ex machina, the magic solution to avoid that. In an ideal world, we would have all countries applying exactly the same rules. But as long as that's not the case, it's I think in the interest of the member states, obviously, of all the countries to align their rules. If not, you will have these misfortunes. But again, it's not a new phenomenon. It already existed in the EU. We have had cases about leasing of cars where one country said, I consider that to be a sale of a car, so it's a delivery of a good, and another country said, no, it's a service, it's a rent. So and with the end result that the VAT was due nowhere. There is a famous case, Royal Bank of Scotland, that was involved in that, and the Court of Justice said, well, if that's the case, then there is no VAT. It's not an abusive practice. So good question, but unfortunately, I don't have a hard answer. Perhaps Michel or Karine, you have something to add to James' question?
I will just add that one of the situation where you may have mismatch is typically the financial services. It's true, of course, in EU, non-EU situation. For example, the EU Chancellor in December confirmed that all financial services rendered by banks, insurance companies UK banks and insurance companies to EU clients will open the right to recover VAT to the UK bank insurance companies and so on, meaning that they will have the right to deduct the VAT on their cost, while there will be no VAT due on the services in the EU. And to this extent, the UK bank will be in a better position than an EU bank because it will be a lower cost base. This is one case where effectively there is no harmonization. This could also happen inside the EU because the definitions are different. For example, Belgium allow the option to tax for payment services, and there are many bank and specialized institutions in Belgium that use these options. They could recover the VAT on the cost. They should charge VAT on the services to Belgian clients, but most of the clients are outside Belgium, and these clients have not to pay the VAT on these services, and therefore the Belgian service provider are in a better position than the other EU ones. This is one of the examples that effectively shows that VAT, even within the EU, is not yet harmonized or not yet fully harmonized.
Okay,
Yes.
Those are great answers. We're running a bit over on time, but we have several questions. But in the interest of time, let me group them. We have a couple of questions on Luxembourg legal and accounting services billed to the UK. How do the new rules impact that?
Yes. So if a Luxembourg accountant invoices a UK client, what is new is that if the client is a business, before or post Brexit, there would be no Luxembourg VAT. However, what is new is when the client is not a business, so it's not a taxpayer, a private individual, for instance, or a passive holding company. Then under the rules before Brexit, Luxembourg VAT would be charged and obviously not be deductible by the UK client, being not a taxpayer, not an individual or passive holding company or a public authority. Whereas after Brexit, UK being now outside the EU, the place of service of the accountant or the lawyer or other similar type of service providers would be deemed to be in the UK, meaning that so going forward, the UK, the Luxembourg accountant does no longer have to charge Luxembourg VAT. Whomever the client is, a business or private individual, obviously to be verified whether or not under the UK VAT rules, this would attract any UK VAT, so that in the end, the client might be liable for that UK VAT. That I haven't verified, but as far as the EU is concerned, the result is that in that case, indeed, whereas before the Luxembourg accountant needed to invoice his service with 70% Luxembourg VAT, he no longer has to do that as of this year.
Okay, and our last question, we have a few questions about mixed projects. So one of our panelists is asking about providing engineering services, which might include supply of goods such as hardware and supply of services. How do you go about the tricky situation of separating goods and services that are all bound into one overarching contract? And does that have an impact? Maybe Karine.
Yeah. So first, it is important to assess the contract, the global contract, and the corresponding VAT treatment. But at the end, assuming that the hardware is delivered physically from Luxembourg to the UK, there won't be any Luxembourg VAT due because it is a VAT exempted exportation, because UK is a third territory. The services anyway are subject to VAT at the place of the recipient. What is important to consider, however, is under which condition do you sell the hardware to your UK clients? We usually refer to the Incode terms, and assuming you want to sell the hardware all tax and VAT included, the company in principle should register for UK VAT and sell the hardware with UK VAT. But assuming you don't sell the hardware duty included, then it is the responsibility of your client to manage the customs clearance at destination. And so the sale of the hardware will anyway be without Luxembourg VAT because it is a VAT exempt transaction. So you see, what is very important is eventually to determine the level of obligation of the company, of the Luxembourg company in the UK, depending on the sale conditions to the UK client.
Okay, all right, we're under pressure now to wrap it up. So thank you for your questions, participants. A big thank you to our three panelists. Thank you, Karine, Michel, and Guido. Excellent presentations. A big thank you to Deloitte, who sponsored this, and a special thank you to our esteemed chairman, Jonathan Norman, who is away on with his second child in his family, so he's quite busy, and he's done a great job, of course, in the leadership of the BCC Tax Committee, and we'll look forward to having him back. And with that, should I turn it over to Danielle or Rebecca?
Yeah, thank you very much. Thank you very much, James. Just a quick concluding note from my side. Thanks as well, Karine, Michel, Guido. Great event. Thanks for really the very enlightening and informative information that you shared with us. I think it's really been a very high quality. It really shows the high level of quality of the BCC tax groups events that are being organized and the great speakers we have on board. So thanks, James, as well, for coordinating the panel. Thanks to all the people on the call for participating and for asking questions. Maybe just a concluding word from myself. We're almost at the end of February. March is coming up. March is going to be a very active month for the British Chamber of Commerce. We're going to have a total of 5 events, and they're going to be really very interesting. Almost in connection with what we had today, we're going to have on 2nd of March, we're going to have a conference, a joint conference with the British Chamber of Commerce UK, and it's going to be on the future of UK-EU trade relations with a focus on services and data. So that's going to be also very high profile speakers on the call together with the British Chamber of Commerce in the UK. 8th of March, it's going to be a flagship event. It's going to be International Women's Day. And our People in Leadership group have put together a very interesting panel. We'll have, among others, Minister Paulette Lehnert, who's going to speak to us. So it's going to be really interesting. 16th of March, it's going to be the last Brexit briefing for our sustaining members done by Ambassador John Marshall, because he's about to leave. I think a couple of days later, he's going to leave and the new ambassadors are going to come in. So it's been a tradition over the last years to have the sustaining member Brexit briefing, and it's going to be the last one on 16th of March. 18th of March, we're going to have a topic insurance industry post-COVID, and on the 24th of March, we're going to have a legal update. So please join us for all these events, or the ones that are interesting for you, and I'm really looking forward to see you all again. Thanks again to the panelists. Thanks, James. Thanks to Deloitte, and bon appétit. Have a great day.